What if you're paying yourself completely wrong from your drone business? Most people do. In fact, the wrong pay strategy can cost you thousands in extra taxes and drain your bank account. To help you avoid that, I'll share the exact system I use with all drone pilots I work with, and so far I've kept all of them happy. I'll explain what the dividend trap is and show you how much money you actually get to keep with this strategy. To start, let me show you what level of salary you need to take so you're paying the least amount of tax. Choosing how to pay yourself is like defeating the final boss in a video game. You've got different weapons, salary, dividends, and various allowances you're entitled to. But when you reach the final stage of the game, you will be defeated despite your best efforts unless you choose the right combination of weapons. Then you win the game if you manage to escape with most of the gold you worked so hard for. But how do you choose the right combination of weapons? Well, let me show you. First, set your salary to no more than £12,570 for the year. That's the magic number. I've done the calculations with all possible salary amounts, and this is the one that makes the most sense. The reason is that this salary takes up your entire personal allowance, but you also build up your state pension and benefits while avoiding personal national insurance contributions, although you still pay a small amount as an employer. However, if your company has additional employees or qualifies for the employment allowance, you may be able to eliminate even the small employer national insurance charge. But for companies with only one employee who is also the director, this isn't available. Paying this level of salary also saves you corporation tax because it's treated as a business expense. Next, pay the rest of your income as dividends. Dividends are taxed at lower rates and avoid national insurance completely, both for you and your company. You also get a dividend allowance, which lets you receive some dividend tax-free. This allowance has dropped over the years from £2,000 3 years ago to just £500 today, but it still provides benefits. But here's the thing, paying yourself dividends can get you in big trouble if you don't understand how they work. Think of your company profits like a tasty chocolate cake. Before you can devour the whole thing for lunch, you need to set aside a plate for your neighbor who always gets a slice. The cake that's left after serving your neighbor is the part you're allowed to enjoy. However, if you start eating the cake before you know exactly how much your neighbor wants, and he can be greedy sometimes, you might accidentally eat more than you're allowed. When he shows up and sees his slice isn't there, he's gonna want his part of the cake anyway. That leaves you owing him something you don't have anymore. And that's how you get into the trap, paying yourself too much in dividends before checking if you have enough profit after tax to cover them. Because what happens is, HMRC would treat it as if you borrowed this extra money from your company, and they expect you to pay it back just like you would with any loan from a third party, like a bank or a mortgage lender. Now that you know what the dividend trap is, let me show you how to stay out of it. First, keep a close eye on your profits after tax throughout the year to make sure you can cover your dividend payments. Your profit after tax is simply the total income your business earned minus the total expenses your business had, then apply the corporation tax rate to what's left, and then the final number is what you can safely take as dividends. If you need more money than this number allows, just pay yourself extra salary, because then you're making a business expense, so you don't have to worry about overpaying dividends. I recommend checking your profit after tax at least every quarter. Of course, it's much easier if you have an accountant handling this for you, so if you need help, feel free to reach out or drop a comment below. Now that you have the right setup, let's see exactly how much money you get to keep if you follow this approach. Let's say your business earns £70,000 for the year. You pay £7,000 in subscriptions, £8,000 for travel, and £12,570 as your salary, which is also a deductible expense. After all that, your taxable profit is calculated and you pay 19% corporation tax. That leaves you with net income or profit available for dividends of $34,368. You don't pay any income tax on your salary because it's fully covered by your personal allowance, and assuming you take all remaining profits as dividends, you pay a little bit of tax on them. In the end, your total personal income from salary and dividends would be $43,975 for the year, which works out to about $3,600 per month after taxes. Keep in mind that your company also pays corporation tax and employer national insurance, but those are handled inside the business. Here we're only focusing on how much you take home personally. So here's exactly how to follow this strategy. First, set your salary at £1,470.50 per month and use a payroll software to make sure it's properly declared. Then pay the rest as dividends, but make sure you don't fall into the dividend trap, and of course everyone's personal situation is different. If you have other income, spouse, or specific financial goals, your optimal pay strategy may need adjusting, and that's where professional advice can really help. Now you know how to pay yourself effectively. But if you're not claiming all the tax deductions that are available, you still end up overpaying on taxes regardless of how good your pay strategy is. So watch this video next where I'll show you the biggest tax deductions that save drone pilots thousands.